Okay, this is intended to be a short introduction to accounting for a defined benefit plan. Defined contribution plan is pretty simple. The company is supposed to contribute X dollars every year. A defined benefit plan is a lot more complicated. A defined benefit plan means that in the future the company is going to have to pay out certain defined amounts to various employees, and so there's lots of variables. How long do the employees have to work before they're vested? What will their salaries look like upon retirement? How many employees will hang around long enough to collect, and how long will they live after they retire? So an actuary makes estimates of all these things and finds the present value of those future payments. And that's called the projected benefit obligation, and that's a liability of the company. So let's take a look at a really simple worksheet. In this example, it tells us the plan assets, the stocks and bonds and real estate we've set aside, have a value of $100,000. We're also told that the actuary has calculated that the projected benefit obligation is $100,000. So it's not overfunded or not underfunded. First thing that happens is we're told that the annual service costs, the new benefits earned by our employees this year, are $9,000. So that means that our pension expense goes up by $9,000. Spencer debits, Spencer debits. And out here in these memo accounts, this worksheet area that will make sense to you, hopefully in the next few minutes, we book a $9,000 credit because the PBO has increased by $9,000. Then it tells us that the settlement rate, the discount rate that's used by the actuary to find the present value, is 10%. So that obligation of $100,000 is now 1 year closer. So just like when we increase an asset retirement obligation every year, we're going to do the same thing with this obligation and add on 10% interest. So a $100,000 obligation is now 1 year closer. $100,000 times 10% is $10,000. So we debit pension expense for $10,000 and increase that pension benefit obligation by $10,000. Next, we're told that the actual return on plan assets is $10,000, which is the same as the expected return. So since the plan assets increased in value by $10,000, that's good news for our pension expense. That's money we don't have to put in because the plan assets earn that for us. And so out here in the memo accounts, the plan assets are assets that are set aside to cover this obligation, go up by $10,000. We'll always track actual return, and what will happen, of course, over time is sometimes it'll be more and sometimes it'll be less. That more or less will get captured in other comprehensive income, and we'll be okay with that until it gets beyond what we call the corridor. If it gets too high or too low, then we'll amortize it. But that's a topic for another video on another day. Next, the problem tells us that we contribute $8,000 cash to the plan assets. So we take an $8,000 credit to cash and increase the plan assets by $8,000. Then we're told that the plan paid out $7,000 to retirees. Why don't you pause this video and see if you can figure out what that looks like. Perfect. The projected benefit obligation decreases. Remember, this is a liability account, so it increases with credits, decreases with debits, and our plan assets decreased with a credit because we paid out $7,000 in cash. So now we can use our worksheet to figure out what our journal entry looks like. These guys over here are going to give us our debits and our credits. So we add up all these. We've got a $9,000 debit, $10,000 debit, $10,000 credits. We're back at $9,000. Our credit is to cash for $8,000. That journal entry doesn't balance. And why not? Because our pension benefit obligation is now underfunded. Let's see how that works. If we add that $1,000 credit, now we've got $9,000 worth of credits and $9,000 worth of debits. We looked over here on our memo accounts, and sure enough, when we add up this column here, we discover that we have a credit balance of $112,000. That's our liability, and only $111,000 in our plan assets. So it makes sense that we would have a $1,000 credit or a liability on our balance sheet now for $1,000 because our pension fund is slightly underfunded. The accounting gets a little bit more complicated. Like I said, if our actual return is different than our planned return or our expected return, that difference will accumulate in another comprehensive income until it gets too big. There's also something called prior service costs. So if for some reason we agree to pay benefits to employees for years previous to this year, that's called a prior service cost. We'll also book that all in the projected benefit obligation and in another column over here for other comprehensive income. And what we'll do over time is we'll amortize that out of there. All right, and so the cool thing about pension benefit accounting is if you understand the worksheet, you're 90% of the way there. I hope this helps.